Accounting for adjusting journal entries. Let's get right into it. Our first example is going to be over inventory. Johnny Rock Gravel Co. sells gravel and other small stones on wholesale to local construction companies. Johnny Rock accounts for inventory periodically using a physical count each month. This is still a pretty common method for accounting for inventory, so while some companies will use the perpetual method and have a live running count of their inventory, it's not uncommon to still see the periodic, which makes for a good adjusting journal entry. And a common example you'll see on tests and in accounting classes. On July 1st, the gravel inventory count was at 2,450,000. The physical inventory count on July 31st at the end of the month was 2,600,000. Gravel inventory purchases for the month totaled 500,000. So given all this information, we're asked to record the adjusting journal entry to account for inventory usage in July, or you could rephrase that and say inventory like expense, if you will, or gravel expense, the amount of gravel that was used for the month. So we can find this out with the information that we have, and we'll see that here. To figure this out, we're going to start with beginning inventory of 2,450,000, and we're going to add the purchases of 500,000. This gives us a total of 2,950,000. So why did we do that? By starting with what we had, we add the purchases for the entire month so that we know total inventory available. So this is the inventory we have available to use for the entire month. Obviously, we're expecting some to be left over at the end, but this is our total that we have available to use. And then from this number, total available, we'll subtract the final inventory, what was left over at the end of the month, to see how much we used. The final inventory was 2,600,000. So when we subtract that from 2,950,000, we get 350,000. And this is how much inventory that we used in July. So the journal entry to record that expense of 350,000 will look like this. Debit cost of goods sold. If we're selling gravel as an end product, if not, the expense could be gravel expense or some type of inventory expense. And then we're going to credit gravel inventory. So the debit to cost of goods sold will hit the income statement as an expense. Gravel inventory, the credit there of 350,000 will reduce the inventory account with that credit, so it will reduce the inventory account on the balance sheet. Example number 2, payroll. Drake and Kendrick attorneys are closing the books for year-end 2024. The last payday for the company was on December 29th, 2024. Employee wages owed for December 30th and 31st totaled $3,750. Payroll taxes for those days totaled $1,344. And then we're asked, what entry must D&K attorneys record on December 31st, 2024 to account for wages not paid at year end? So again, this is a super common question for accruals and for adjusting entries in accounting. And you might be wondering why we even have to do this. And in accrual accounting, right, not cash basis, in accrual accounting, we have to record expenses when they are incurred. So even though wages that were earned by employees on December 30th and 31st won't be paid until sometime in January, we have to record those expenses incurred in 2024 when they were earned by the employees, even though they haven't been paid out yet. And the same for the payroll taxes. So let's take a look at how that works. We're going to have 2 journal entries here, or you could put it on one, but we'll do both sides of the entry separately. So the salary and wages expense of $3,750, we're going to go ahead and debit that as an expense, again, because we have to recognize that in 2024, even though it hasn't been paid out as cash yet. And then the credit to that journal entry for the same amount will be to salary and wages payable. So this is a liability on the balance sheet account, and it's just showing that we owe this much in salary and wages, and it's going to be paid out. It's a liability, but it just hasn't been paid yet. And then same thing for payroll tax expense. We record this separately because payroll tax expense is going to be remitted to your state agency, Department of Revenue, and then also the federal IRS for payroll taxes collected. So we would do the same type of entry though. We're going to debit payroll tax expense to recognize 2024, those 2 days, December 30th and 31st, the payroll taxes that we owe to the government. And then we're going to credit payroll tax payable to show a liability in the balance sheet account so that we know and can present that we owe this money as of year end to state 2024 financials as accurately as possible. And again, this is a feature of accrual accounting to show that expenses incurred in that period are fully recognized, even though in a cash basis situation, this hasn't been paid yet. Example 3, error correction. On January 1st, 2024, the accountant at the Pink Pony Club paid $500,000 for a 5-year insurance policy. They record the following journal entry. They recorded a debit to insurance expense for the full $500,000 and credited cash for $500,000, reflecting the payment. On December 31st, 2024, at the end of that same year, an auditor informed the accountant that this entry was not made correctly. What was the appropriate adjusting journal entry made on 12/31/2024? So, if you're not familiar with this type of situation, or this error, even if you're not sure what happened, we'll break that down first. So the accountant originally recorded this entire 5-year insurance policy as an expense in 2024. And you might think that seems right. And in a cash-based situation, that would be true. But again, in accrual accounting under U.S. GAAP, we have to record expenses in the period that they are incurred. So for a 5-year insurance policy purchased on January 1st, we're only using 1 out of 5 years in 2024. The other 4 years are going to be used up in the subsequent 4 years. So to be in line with GAAP and the matching principle of matching expenses to the period they were incurred, we actually only want to reflect 1 year of that insurance policy as an expense. So to do that, we actually need to take back some of that expense. That $500,000 represents 5 years. And since it's $500,000 for 5 years, each year is $100,000 for that insurance policy, we can assume, unless it's stated differently in the policy. So to make this adjusting journal entry to correct 2024, we need to remove 4 years of expense, or $400,000. So to do that, we will debit prepaid insurance for $400,000 and then credit insurance expense for $400,000. So the credit to insurance expense makes sense, hopefully for most people. It's going to reverse what we did earlier. So if we debited $500,000 earlier and then credited $400,000 now, we'll be left with $100,000 in insurance expense, and that will be correct and displayed correctly on the income statement. The debit to prepaid insurance is a little bit trickier. That is going to be an asset account, a current asset account on your balance sheet. And what that is it's considered an asset because it is a future benefit to us that we've paid, but it's not ready to be an expense yet. So for each of the 4 subsequent years, we will constantly reduce that prepaid insurance expense account and then debit insurance expense. So in the following years, we would see a journal entry where you debit insurance expense for $100,000 and you credit prepaid insurance by $100,000 to slowly lower that prepaid insurance account, if you will, as we're using it up and recognizing it in the period that it's being used. That's all I've got for you today. Leave a comment below, a question, if there's a problem you want to see, I'm happy to answer it.